Don't look for the one needle in the haystack to invest in. Just buy the entire haystack. This famous advice from Vanguard founder John Bogle reminds us that instead of chasing hot stock tips, it's smarter to own the whole market. In other words, don't gamble on finding that one winning stock, the needle. Buy a broad basket of stocks, like an ETF, and you'll automatically own all the needles, current and future, hidden in the haystack. Today, we're going to apply that wisdom to building your retirement portfolio with ETFs. If you're between 50 and 65 and starting from scratch, or close to it, don't panic. This video will give you a clear step-by-step game plan, with a dash of humor and a lot of honesty, to help you start investing confidently for the future you deserve. Before we dive in, a quick but important disclaimer. This video is for educational purposes only. It is not personal financial advice. Everyone's situation is unique, especially when starting late. We'll cover general strategies and examples, but you should consider consulting a certified financial planner for advice tailored to your life. As one financial education source puts it, these concepts should not be considered investment advice or a recommendation of any particular security, strategy, or product. In short, we're here to inform and encourage you, not to tell you exactly what to do with your money. Now, let's get started on building your financial future. So you're 50, 55, or 60 years old with little to no retirement savings. First, take a deep breath. You might be feeling anxious or even ashamed, maybe thinking, I'm so behind, is it even worth starting now? The answer is yes. It's better late than never. In fact, if you're 50 and haven't started saving for retirement, don't panic. Many people are in the same boat. About 1/3 of Americans feel they're not on track for retirement, so you are not alone, and it's not too late to begin. What's crucial is starting as soon as possible and staying consistent. Even though you have less time for compounding than someone who started at 25, you still have a shot at retiring comfortably at a reasonable age, even if you only start at 50. That's right. By making the most of the coming years, you can still build a meaningful nest egg. The key is to prioritize saving and investing now and avoid common pitfalls, like taking on too much risk out of desperation or, on the flip side, being so conservative that your money never has a chance to grow. We'll find a balanced approach for you. A positive mindset is step one. Instead of dwelling on the past, focus on what you can do now. Think of it this way. The best time to plant a tree was 20 years ago. The second best time is today. Likewise, the best time to start investing was years ago, but the second best time is right now. You can't change the past, but you can change your future by taking action. So let's replace "it's too late for me" with "I can start now and improve my future." What exactly is an ETF? Now that we have the right mindset, let's talk about our main tool, ETFs. ETF stands for Exchange Traded Fund. That sounds fancy, but it's actually a simple concept. An ETF is basically a basket of investments. It pools money from many people and invests in dozens or even hundreds of securities, like stocks or bonds, all at once. When you buy a share of an ETF, you're buying a tiny slice of all those investments in the basket. It's like a prepackaged sampler of the market. Think of an ETF as a haystack, to recall our intro quote. It contains lots of needles, companies. Each ETF share represents your part ownership of that whole haystack, including all the assets and income inside it. For example, one popular ETF tracks the S&P 500 index, which means it holds shares of the 500 largest companies in the US in one fund. If you buy that ETF, you instantly own a piece of big companies like Apple, Amazon, Johnson & Johnson, etc., without having to buy each stock individually. Why do people love ETFs? They come with some great benefits. Diversification. Because an ETF invests in a range of companies or assets, you're not putting all your eggs in one basket. If one company in the fund has a bad day, it's buffered by the others. Many ETFs invest in a broad mix of industries, which helps lower your risk if any single stock or sector slumps. Of course, some specialized ETFs focus on one sector, but you can choose broad ones for a strong foundation. Professional management. Most ETFs are created by financial companies and are managed by professional portfolio managers. You don't have to be the expert stock picker. The ETF does that for you according to its strategy. Low cost and low minimums. You can often get started with a relatively small amount of money. ETF shares trade on exchanges like stocks, and many trade at affordable prices, and nowadays many brokers even allow fractional shares, which we'll discuss later. Also, ETFs tend to have lower fees than traditional mutual funds. They're known for efficiency and low expense ratios, liquidity and flexibility. You can buy or sell an ETF at any time during the trading day, just like a stock. Need cash or see a better opportunity? You're not locked in. You can trade whenever the stock market is open. Transparency. Most ETFs publish their holdings daily, so you always know what's inside your fund. No surprises. Tax efficiency. This is a bit technical, but ETFs often generate fewer taxable capital gains than mutual funds held in a regular brokerage account. For our purposes, if you're investing inside a Roth IRA or other retirement account, taxes aren't an immediate concern. But it's nice to know ETFs are generally tax-savvy investments. In short, ETFs give you diversification, convenience, and cost-effectiveness in one package. They truly are a great foundation for a portfolio, especially for folks who don't have the time or appetite to research and manage a bunch of individual stocks. As the SEC, Securities and Exchange Commission, points out, ETFs let everyday investors pool their money and get the benefit of a professionally managed, diversified portfolio at a low cost. That's a perfect recipe for someone starting later in life who needs simplicity and reliability. Why ETFs make a solid foundation. You might be wondering, why ETFs? Can't I just pick some stocks or maybe keep money in the bank? You could, but let's consider the situation. Starting at age 50 or 60, you don't have a lot of time for do-overs or trial and error in investing. Picking individual stocks is risky. Even professional stock pickers often underperform the market. At this stage, you want steady growth and/or income with minimal fuss. ETFs provide exactly that. A solid, diversified foundation that grows with the overall market. Historical data shows that a broad market index, like the S&P 500, has delivered about 10% average annual returns over many decades, around 6 to 7% after inflation. While future returns aren't guaranteed, past performance does not predict future results, as every investment disclosure will tell you. This gives a sense that the haystack as a whole tends to grow over time, thanks to the collective strength of many companies. If you try to chase the one needle, say a hot tech stock, at age 60, you might strike gold, or you might strike out and lose precious savings. By buying the haystack through ETFs, you increase the odds of capturing the overall growth trend while reducing the impact if any one company fails. Another reason ETFs are great as a foundation: simplicity and peace of mind. Instead of constantly worrying, did I pick the right stock? Should I sell this? Buy that? You can relax a bit knowing you own a broad swath of the market. You become a passive investor riding the market's general upward trajectory, rather than a gambler at the stock casino. This is especially important for late starters. You likely don't have time to recover from a major mistake on a speculative bet. With core ETFs, you're taking a measured, proven approach. Lastly, using ETFs aligns perfectly with the mindset shift we want, from short-term speculation to long-term planning. It encourages you to think in terms of asset allocation, mixing different types of investments for balance rather than stock picking. As the SEC's investor guide says, don't put all your eggs in one basket. Diversify. ETFs make diversification a no-brainer. They also can include other asset types, bonds, real estate, etc., via specific ETFs, which we'll touch on. Overall, ETFs are the scaffolding of the retirement house we're building. They hold everything up securely. Growth versus income. Using ETFs for your goals. When constructing your portfolio, it's important to understand your goal. Do you want growth, to build your balance as much as possible, or income to generate cash flow you can use, or a bit of both. Growth ETFs. These are funds that focus on companies expected to grow quickly in value. Growth companies often reinvest profits into expanding, rather than paying big dividends. A growth ETF might track an index of companies with above-average earnings growth. Think tech companies, innovators, etc. For example, Schwab U.S. Large Cap Growth ETF, SCHG, or Invesco QQQ Trust, QQQ, which tracks the NASDAQ 100, are growth-oriented. Such funds can produce above-average returns in the long term, but they also carry more short-term risk, meaning their prices can swing more wildly. Growth ETFs are great when you have enough time to ride out market ups and downs, because they can outpace the broader market over years. At age 50, with 15-plus years ahead, you might include some growth ETFs to boost your nest egg's potential. At 60, you'd use them more cautiously, since you have fewer years to recover from volatility. In short, growth ETFs equals more growth potential, but more ups and downs. Income and dividend ETFs. These funds invest in stable, dividend-paying companies that share profits with investors regularly. Dividend ETFs aim to give you a stable, steady income by focusing on stocks with higher-than-average dividend yields. Think of solid companies like utilities, consumer staples, or other blue-chip firms that might not double in size, but will likely keep churning out dividends. For example, Schwab U.S. Dividend Equity ETF, SCHD, or iShares Core Dividend Growth ETF, DGRO, hold baskets of companies known for reliable dividends. Dividend ETFs are popular with retirees, or near retirees, because they provide cash flow. You can reinvest those dividends while you're still saving, more on that shortly, and later, in retirement, you might take the dividends as income to help pay your bills. These funds are generally a bit less volatile than growth stocks because companies paying dividends tend to be mature and stable. However, don't expect huge price jumps from them. The trade-off is lower growth, more stability. Reinvesting dividends. If you invest in income-focused ETFs now, while you're still in the saving or building phase, a smart strategy is to reinvest those dividends rather than taking the cash. Reinvesting means whenever the ETF pays you a dividend, you use that money to automatically buy more shares of the ETF. This way, you harness the power of compounding. Each new share you buy with dividends will itself produce future dividends, which buy even more shares and so on. It's a virtuous cycle. Over time, this can supercharge your long-term returns because of compounding. Most brokerage platforms let you enroll in an automatic dividend reinvestment plan, DRIP, for free. This is highly recommended during your pre-retirement accumulation years. Later, once you retire and need income, you can turn off DRIP and start taking the dividends in cash to supplement your other income. To illustrate the power of reinvested dividends, imagine an ETF yields 4% annually. If you take that 4% as cash, you'll have 4% in hand each year, minus any taxes if in a taxable account. But if you reinvest it, you'll be buying more shares. As those shares hopefully appreciate and pay dividends themselves, your overall investment can grow much faster. In fact, many studies show that reinvested dividends account for a large portion of total stock market returns over decades. It's like planting seeds from a fruit-bearing tree to grow more trees. So, unless you absolutely need the money now, reinvesting dividends is the way to go. High-yield ETFs. I'll put this under the income category, but it's a special subset. High-yield ETFs aim to pay even higher income by employing specific strategies. Some hold high-dividend stocks, which can sometimes be riskier companies or in certain sectors, and some use an options strategy, covered calls, to generate extra income. One example that's become popular is JP Morgan Equity Premium Income, ETF, JEPI. JEPI invests in large U.S. stocks, kind of like the S&P 500, but also sells call options on those stocks to generate additional income. Without getting too technical, it's trading some upside potential for immediate income. The result: JEPI can yield around 7 to 10% annually in distributions, much higher than normal stock dividends. That's great for income now, but the trade-off is that if the stock market soars, JEPI won't capture all those gains because of the calls it sold. Also, high-yield funds can have complex risks, and their dividends can fluctuate. Use them in moderation and understand them before buying. They can be a nice supplement for income, especially as you approach retirement, but they shouldn't be 100% of your strategy. REIT ETFs. A quick mention of another income-focused investment. Real Estate Investment Trusts, REITs. REITs are companies that own income-producing real estate, like shopping centers, apartments, etc., and they are legally required to pay out most of their earnings as dividends to shareholders. REIT-focused ETFs give you a way to invest in real estate without buying property yourself. These often provide higher dividend yields than typical stock funds. For example, Vanguard Real Estate ETF, VNQ, holds dozens of REITs and typically yields around 3 to 4%, sometimes more. REITs can add diversification to your portfolio. Real estate often behaves differently than other stocks. And a stream of income. But note, REIT prices can be sensitive to interest rates and economic cycles. They're a good component of a portfolio, but, again, use in balance. We include REIT ETFs as part of the foundation categories because they are a common piece of a well-rounded portfolio, contributing income and diversification. Putting it together. Generally, when you're still in the growth phase, saving up before retirement, you might tilt more toward growth ETFs and broad market foundation ETFs and reinvest any dividends. As you approach or enter retirement, you might tilt more toward dividend and high-yield ETFs to enjoy the income. We'll talk about adjusting allocation by age in a bit. The beauty of ETFs is you can mix and match to suit your goals, growth, income, or a blend. And remember, dollar cost averaging, DCA, works wonderfully with ETFs. That means investing a fixed amount on a regular schedule, which we'll cover next. The power of dollar cost averaging. Let's introduce one of your best friends in investing, dollar cost averaging, DCA. The concept is simple but powerful. Invest a fixed amount of money at regular intervals no matter what the market is doing. For example, you decide to invest $200 on the first of every month into your ETF portfolio. Sometimes you'll be buying when prices are up, sometimes when they're down. But over time, this evens out your purchase price. You buy more of an investment when its price is low and less when its price is high, automatically. DCA takes the guesswork and emotional angst out of investing. Why is this great for someone starting at age 50 to 65? Because it protects you from the risk of bad timing. Imagine dumping all your savings into the market at once, only to have a big downturn the next month. Ouch. With DCA, if the market dips, it's actually okay, even good, because your next scheduled contribution will buy shares at that lower price. If the market rises, great. The money you already invested is growing, and you buy slightly fewer shares next time because of the higher price. In essence, DCA smooths out the ride. It helps prevent the paralysis of, when should I invest? The answer becomes, consistently, according to plan. Most importantly, DCA instills discipline. It turns saving and investing into a habit, like paying a bill to your future self. You can set up automatic contributions so it happens without effort. Through bull and bear markets, you keep on investing, which studies have shown yields good results for long-term investors. The SEC itself suggests that by following a DCA strategy, you can avoid investing all your money at a market peak and instead spread out your risk over time. For late starters, DCA is comforting because it creates a sense of progress. Every month or every paycheck, you're doing something tangible to improve your future. It's like steadily climbing a hill step by step, rather than trying to pole vault to the top. And trust us, time in the market, even if shorter for you than someone who started younger, is far more important than timing the market. Very few can time the market perfectly, and it's extra risky to try when you can't afford setbacks. DCA says, don't try to be a fortune teller. Just keep planting seeds regularly. Quick example, suppose you decide to invest $500 a month into a broad ETF. If the market is high this month, your $500 might buy, say, 5 shares. If the market crashes next month, maybe that $500 buys 6 shares because they got cheaper. Later, the market recovers and those shares are worth much more. You end up better off for having kept investing during the downturn. DCA helped turn the downturn to your advantage, buying low. And if the market had just kept rising? Well, your early purchases appreciated, and your later purchases bought fewer shares but at higher value, you still gained. It's a win-win versus trying to all in at a perfect time. The takeaway, set up an investing schedule and stick to it. Treat your investments like a recurring bill. We'll discuss how much to contribute in a moment when we talk budgeting and guidelines by age. But even if it's $50 a week or $200 a month, consistency is key. A consistent smaller amount beats a one-time big amount, followed by inaction. DCA also helps manage emotions. You won't be as tempted to skip investing or sell in panic when you've got a systematic plan in place.